Bonds versus mutual funds. Bond and mutual funds are considered the safest and most profitable investments. Both offer the potential for high investment returns, but differ in risk and return profiles. Corporate bonds are generally considered safe investments with a lower risk profile than mutual funds. On the other hand, a mutual fund offers higher returns and a diversified portfolio. Both are good investment opportunities with different risks and returns, making them ideal for different types of investors. In this video, we will dig deep into the difference between a bond and a mutual fund, looking at the advantages and disadvantages of both options, and which type of investor should consider which investment. So if you need clarification about which one to pick, this video will help you understand what each one offers and the appropriate ways to invest in them. Before we begin, please don't forget to subscribe. It really helps me to bring you more great content. Thanks. Let's get into the video. What are bonds? Bonds are fixed income securities that represent debt agreements in the bond market. Governments and corporations issue them, and other entities borrow funds and pay them back with interest on a given date. Since reputed corporations and governments back these investments, bond investments are one of the safest options. Bonds may be short-term, medium-term, or long-term investments, depending on the length of their maturity. Bonds can also offer investors steady income through interest rates and capital appreciation if the bond is held until maturity. However, the returns are usually lower than what the stock market offers, making them attractive for those who want a more conservative investment approach. It offers a steady income that might be better for investors looking for a more stable and low-risk investment. How do bonds work? Bonds typically offer a fixed and steady interest rate paid out of the issuer's revenue. The bondholder will receive the principal amount plus any accumulated interest when the bond matures. Bondholders can also trade them in for a profit or loss before maturity. When investors purchase a bond fund, they hold a portfolio of bonds with different maturity dates, interest rates, and prices. The fund manager manages the bond portfolio to ensure optimal returns without exposing investors to too much risk. Once the bond fund matures, the investor will be able to receive back the net asset value, plus any accumulated interest. Governments might issue bonds to raise money for projects such as roads, bridges, and infrastructure. As a bond issuer, it will pay interest to bondholders who purchase these bonds as a form of repayment. What are mutual funds? Mutual funds are actively managed funds that invest in a diversified portfolio of stocks, bonds, bond mutual funds, and other securities. The fund manager actively manages the mutual fund to ensure it meets its objectives, while keeping the risk within acceptable levels. Mutual funds offer investors higher returns than bonds, but with increased volatility and risk. However, the stakes are much lower than the direct stock or money market funds, as your portfolio will be handled by a professional fund manager. In simple words, mutual funds are index funds, actively managed and offer the diversification, allowing investors to put their money in various assets. Like an index fund, various mutual fund types and strategies range from aggressive to conservative. Mutual funds also offer greater liquidity than bonds, allowing investors to quickly liquidate their holdings and access funds. How do mutual funds work? Mutual funds are funds managed by professional fund managers who actively manage the fund to meet its objectives. The fund manager will use various investment strategies such as buying and selling stocks, bonds, and other securities to generate returns through interest payments for the investors. The interest rates rise and fall according to the performance of the underlying assets in the fund. The fees associated with mutual funds are usually higher than those for other investments, as there is an additional cost for active management and research. As a retail investor, you can choose from a wide range of mutual funds, depending on your investment goals and risk tolerance. Similar to exchange-traded funds, or ETFs for short, mutual funds can be bought and sold through a broker or financial advisor, making them a convenient investment option. Let's look into some of the pros and cons of bonds. 1. Bonds are a safe investment option. Individual bonds are some of the most secure investments, offering a guaranteed return to the bondholder. Since governments and other reputed institutions back them, they are relatively low-risk investments. 2. Fixed income. Bonds provide a steady income stream in the form of interest payments, making them ideal for investors looking for predictable returns. In addition, interest payments are subject to taxation once they are received. 3. Less volatile. One of the biggest concerns most investors have is market volatility, but bonds are known to be less volatile compared to other investments such as stocks, which makes them ideal for investors looking for a safe and steady return. 4. Bonds have transparent ratings. Bonds have transparent ratings that help investors assess the risk of their investments. These ratings are based on several factors, such as the issuer's creditworthiness and the security's maturity date. This way, you can do your due diligence before investing in any bond. 5. Bonds are backed by larger entities. Bonds are usually backed by large entities such as governments and corporations. This gives them an additional layer of safety, which is not found in other investment options. This also offers peace of mind knowing that your money is safe. Cons. 1. Low returns. One of the most significant disadvantages of bonds is that they offer low returns compared to other investments, such as mutual funds or stocks. In addition, interest rates are usually lower than inflation, which means that the value of your investment may not grow over time. 2. Fixed returns. This can be both a pro and a con. While fixed returns are great for investors looking for predictable returns, they may not be suitable for those looking to maximize their earnings over time. But there is no growth potential, so you must be content with the fixed return. 3. Long-term commitment. Investing in bonds requires a long-term commitment, as you must wait for them to mature before you can cash out and receive your returns. This makes them less suitable for investors looking for more short-term investments. 4. Less liquidity. Another disadvantage of bonds is that they are generally less liquid than other investment options. This means you may need help finding someone willing to buy your bonds if you need the money before the maturity date. 5. Large capital required. Bonds usually require significant capital, as most bonds come with a minimum denomination of thousands of dollars. This can be an issue for investors who need more resources. Bonds may not be the best option for you if you are a beginning investor with a limited budget. So now that we know the pros and cons of bonds, let's take a look at some of the pros and cons of mutual funds. Pros. 1. Diversification. Mutual funds offer diversification as they are composed of different types of securities such as stocks, bonds, cash, and other assets. This allows investors to reduce their risk by spreading out their investments. 2. Professional management. Mutual funds are managed by professional fund managers with the expertise and experience to make the best decisions for their investors. This helps to ensure that your investments are in safe hands. 3. Lower costs. Investing in mutual funds typically comes with lower costs than investing in individual securities, such as stocks and bonds. This makes them more affordable and accessible to investors with limited resources. 4. Liquidity. Mutual funds offer more liquidity than bonds, as they can be sold at any time without waiting for them to mature. This makes them an excellent option for investors who need access to their money quickly. 5. Higher returns. Mutual funds offer higher returns over the long term, as they benefit from economies of scale and have plenty of growth opportunities. This makes them an excellent option for investors looking to maximize their earnings. On average, you can expect to get around 7 to 10% yearly returns. Cons. 1. Less control. Since professionals manage your investments, you have less control over them. This may be an issue for investors who opt for having more control over their investments. However, mutual fund managers are highly experienced and qualified, so you can rest assured that your money is in good hands. 2. Market risk. Investing in mutual funds comes with market risks, as the price of the securities may fluctuate depending on market conditions. This means that your returns may be affected by volatility. You have to do your research and make sure you fully understand the risks associated with investing in mutual funds. 3. Fees. Investing in mutual funds usually involves specific fees, such as management and administrative costs. This means you may have to pay more than expected if you're not careful. Make sure you thoroughly read the fine print before investing and understand all the fees involved. 4. Lock-in periods. Even though mutual funds offer more liquidity than bonds, they still have a certain lock-in period. This means you can only access your money after you need it. You may have to pay a fee to withdraw your money before the lock-in period is over. 5. Capital gains. Mutual funds are subject to capital gains taxes, meaning you may have to pay taxes on any profits you make from your investments. This can be an issue for investors who want to avoid incurring additional tax liabilities. What should you invest in, bonds or mutual funds? There's no short answer to these questions, as it depends on your situation and needs. Both bonds and mutual funds offer unique advantages, so it is important to make sure you understand the pros and cons of each before making a decision. Here are several things you should consider before choosing between bonds and mutual funds. 1. Your goals. It is important to consider your long-term investment goals before deciding on the type of investment that you should make. Bonds are best suited for investors who want to preserve their capital and get a consistent income, while mutual funds are better for investors looking for more growth opportunities. 2. Your risk tolerance. It is also essential to consider your risk tolerance when deciding between bonds and mutual funds. Bonds are usually associated with lower levels of risk, while mutual funds come with higher levels of volatility. Bonds may be the better option for you if you are a conservative investor. 3. Fees. It is important to consider the costs of investing in bonds and mutual funds before making a decision. Bonds generally have lower fees than mutual funds, but there are also many fees associated with mutual funds that you should consider. 4. Liquidity. As we've already mentioned, bonds are less liquid than mutual funds, so you may need more time to access your money. Make sure you understand the terms and conditions before investing in either option. As you can see, there is no one-size-fits-all answer when it comes to choosing between bonds and mutual funds. It is essential to consider your situation and needs before deciding about your investments. However, the best thing you can do is to invest in both bonds and mutual funds. This way you can diversify your portfolio and reduce your overall risk. Watch this video next. Don't forget to subscribe, and I'll see you in the next one.